I'm old enough to remember 6 months ago when the 10-year was yielding 50 cents. It's now at $1.28, 1.28%. Still massively low historically, but a huge move in 6 months. Is this the thing that we need to watch the most? Is all of our eyes seem to be somewhere else?
Yeah, I mean, we definitely need to keep an eye on the Treasury yield market for sure. And the move that we've seen recently has been swift, and that's why investors have gotten a little bit nervous. It also could be an indicator of inflation for certain. So that's one reason that people get a little bit nervous. But I would still just remind investors that this is still well below the 2% range. And if you look at the 10-year Treasury yield over a longer period of time, you will see that it's still very low by historical standards. So that's something to keep in mind. I'm not trying to discount the velocity of the move that we've recently seen. But when I look at the market reaction to big moves, on a monthly basis, in the month of February, we've seen the 10-year yield move about 20 basis points so far. I went back and looked. When the 10-year moves about 50 basis points in a month, you do see a slight decline in that same month in the S&P 500. But on a 12-month basis, you'll see the S&P 500 up double digit, or up 8%, excuse me. So I think it's something just to keep in mind for investors.
I feel like we just kind of reset back to where we should have been, Lindsay, right? I mean, it's easy to look at a one-year chart of anything, and it's going to look really weird because we had that March terror, right? Everybody here in the Northeast, we got destroyed. COVID running rampant. Nobody knew what to expect. Everything collapsed. Everything sold off. Then we started to learn more, be a little more thoughtful about it. We're kind of back to where maybe we should be or where we were. If we get a $1.9 trillion relief spending bill, is that just going to goose the economy or goose the stock market even more?
Yeah, I'm kind of in the camp with you, Brian. I think we're just kind of getting back to where we should be. The stimulus, I think, is a key. It's been a key, and I've been saying this for several months now, 6 months, 8 months plus. Stimulus has been a key driver of the market for a very long time, and you continue to see the market react to headlines around the stimulus. The latest package is supposed to weigh in at about 1.9 trillion. I think market participants are expecting it to be a little bit less than that, but still in the trillions of dollars. So that's pretty substantial all in when you take together the stimulus that we saw last year and into this year. That's going to equate to about 25% of GDP. So that adds to a deficit that has been widening, and that certainly can be a little bit nerve-wracking for investors.
Shepard Smith here. Thanks for watching CNBC on YouTube.